like a daddy Mac. Dan's 30 years got our way, trading life and markets every day. Rusty's chained to the mines, digging deep day by day. But when Option Omega releases new features, he's free to come out and play option. Omega, you're trading home, where every move makes you feel less alone.
Good morning.
Good morning, everybody. I hope you guys are doing well on this beautiful day. Listen, we're cutting straight to the chase. No NBA games. We're not going to talk about Oklahoma City. We're not going to talk about tariffs. We're going to talk to the man. Joining us this morning is Mr. Mark Anderson. We said yesterday we're going to bring in some reinforcements, and we have brought in some reinforcements. What better way to talk about zero-day, short-dated stuff than talking with a guy who runs a zero-day hedge fund? So, Mark, how are you doing this morning? Thanks for joining us.
Yeah, pretty good. I mean, it's always an exciting day when we get to sell premium. So I'm ready to put up that risk premium and harvest some P&L. But today I'll, take my expert take and bring it to people with, small accounts that maybe expose to pattern day trading and see how we can make some money.
I love it. I love it. So for those who don't know, Mark, everyone starts with a small account for the most part. Yeah. And I'm sure you certainly did. Who are you and why do you know so much about this? What did you do?
So I guess my tagline is kind of construction worker turned zero DT hedge fund manager. But I like to joke, similar to a lot of people that are watching this, is like the YouTube algorithm selected me as like the messiah to be a good zero DT options trader. So like if you upvote good content, it's $1 trillion algorithm that YouTube has, and the more you promote like non-BS, good informational content like you guys get out there, the deeper the internet will feed you good content. And then I just reach out to people, and I run a YouTube channel, and it's relatively small, and you'd be shocked at how many people like I reach out to or respond to and respond back. So that is kind of where I've gotten to it. But I've traded over 1,000 consecutive zero DT trades, and then I've probably sold about 1 million zero DT contracts and over $50 million in zero DT premium as well. So I've been selling a lot.
Yeah. Yeah. You sell a lot.
Yeah.
Yeah. So that's a great introduction. And what we've been doing, we've been talking about the small account challenge. So we're trying to show that there's a way that you can take a small amount of money, and if you're unemotional about it, if you are willing to lose, which it's hard for small money, which means you need to do an appropriate amount of risk, then you really can do okay in the options market. And so we've been looking at long gamma strategies. We've been looking at double calendars. And this week we're looking at premium selling stuff. So I want to jump right in, and I'm going to show you guys something that Mark sent me. So fellas, can you see this here?
Yes.
Okay. So this is 3 strategies, and we're gonna look through these real quick and go from there. So, Mark, do you want to just take them one by one?
Yeah. So I'll go kind of one by one. First one here is just a trend. So this is kind of optional whether you want to stack it on top of the 10 wide that's below it. But basically, kind of the way to look at this is the SPX has risk premium in it, and it mainly has risk premium in it because it's such a great hedging instrument because it's a European, style option. So being the counterparty to that, a lot of people may not want to take that position, but if we take that position, we can be compensated for it over time. So what I tried to do is basically create enough occurrences here. The reason we focused on, basically later in the day is that when we trade later in the day, the leverage is basically cheaper. So if you trade something right off the open that is a 40 delta and 10 wide, basically with that type of environment, you may be paying $1 or $1.50 for a wing. And when you pay $1.50 for a wing, you're essentially buying more of what you think is expensive, and it will kind of basically bring down, what your potential returns are over time. So, I kind of base this on a 25 grand account. Like that may be a little larger, but if you're using this small of an account, you're probably really young and you can kind of handle the risk of what you're doing, or you're just kind of dipping your feet in.
Yeah.
Then kind of this middle one, I think this is like the real, two-step of where you want to go for. So this one will use a profit take. It still is profitable without it. However, it about doubles the drawdown and keeps the same return. But what I did do for this is I only put it on Monday and Friday. So it's still going to basically stay within your trades for a weekly basis. So I would really recommend kind of looking at this one. I think if you click it, we can, look at the exact metrics on that one too, if you wanted to go more in detail for it. But so like, this is pretty good on a 25 grand account with a one lot. You're looking at 3% drawdown and 12 CAGR. So like, I put this together very quickly with what occurred, but on this, if you want to size this up, I think that could be more than responsible. And also what I want to highlight too is like, this isn't just really a guess of what we've done. So you see it comes on Mondays and Fridays, and Mondays and Fridays, I'll send you guys the article afterwards, but there's something called the weekend effect, where basically dealers will suppress their volatility sometime before the close on Friday, and then they'll let it out sometime before the end of day on Monday. So basically there's these giant systematic flows that kind of come in the market that have a little more of a mean reverting nature with Mondays and Fridays. And I'm sure you guys have seen some of those tests. So this, even though it's kind of curve fit and we need to do this to a certain extent with small accounts, there is, thought behind this on basically why it works. And as a lot of you guys have seen, like someone makes some weird tariff announcement, we go up 30 points and then we return back kind of into this, little tent, and we can profit and get out of this. So I think this is a really good one, even with small accounts, to where like you don't even really need to worry about blowing up, your account or whatever you're doing. You could automate it or you could do it manually. It's pretty much set and forget it. So something interesting to look at for everyone on this one too.
Yeah, that's awesome, guys. Any before we move on, Dan, Matt, any thoughts on this one?
Yeah, I was just looking. Yeah, I like this. I like, Mark, I was going to ask you on you mentioned about that, and I like the thinking on the every Monday, Friday that you'll put the trade on, right? And we're putting it on towards the end of the day on Friday. What have you found in your studies? I was one of those dealers you're talking about. I never a dealer, market maker for a long time. And I tell Troy, a lot of times on Thursday, going into Friday, I would start lowering market makers would start lowering the volatility on Thursday in anticipation of Friday, because most retail traders thought they get the free bouquet over the weekend, and they really don't. You just the volatility on Thursday, and then we would just raise it up on Friday, not because we had any control, but because supply and demand. Now you're finding, what you found with the data, which I'm interested in, is more Friday at the end of the day worked best, right? So is this like this is a quick trade, right?
Yeah, I mean, you're in and out. Like we can look at it. So the average time is about an hour. So you do generally need that really, intense market on close decay at the end of the day that's strong. But when we kind of go back to maybe market makers or what dealers are doing, is it's Fridays and Mondays seem to be more of a boom or bust cycle. It's either we have very understated volatility or we have very overstated volatility. But with our mechanics, we can kind of take advantage of these more Goldilocks type pins or whatever is going on. So even though that volatility is always priced the same at expiration with how big those moves are, the distribution of those is more compact. So if you've ever read like Nattenberg volatility and pricing, I would say that like this exemplifies a lot more kurtosis, which is moves within half a standard deviation, than generally times do. And then whatever we're due coming into that pocket is profitable. And the other thing too here that I like to point out is, we're going to be spending a lot of money in small accounts for commission slippage and fees, because we're shopping more legged orders, we're shopping more expensive spreads. So even though this is 10 wide, the cost of those spreads can be a little higher because we have 4 legs closer to the money. So it's really important that we focus on limiting kind of what I like to call our executional drag. So like if you're collecting, on average here about $450, you want to give as little of that money to the broker for, not taking the risk. Like there's no point to give up $40 or 10% of a risk premium to the broker because we want to get compensated for the risk. So the nature of kind of choosing what our levers are with like, we're either going to use a profit take or a stop loss. And then, if we're entering with a trade, we can slowly enter with our settings and we're not walking across a bid-ask spread that's like really volatile from a supply and demand perspective, similar to a stop loss. So I just think the nature of this for a small account is well set up for people. And like, I'll share some more, but if there's certain times of days where just the mix of decay and the cost of the long wings work really well. And around this kind of dealer o'clock area is generally a good time. I'll link an article too, but there's an article that goes into the, demand spread on, what happens around these times as well.
Yeah, too quick. Yeah, and I mean, it's really more of a time thing because it's not, when you get the last half hour, 20 minutes of a day, volatility in most essential thing, there's not much vega there, right? It's a half hour and it's more. I mean, usually by the last half hour of the day, most of the vol on a Friday has been decreased. It's really just, like you said, it's that decay, right? It's really a decay thing, not so much volatility towards the end of the day. The other thing I was going to ask, did you test it all like 5 wide at all? I mean, 5 wide for a small account. I mean, 2 questions. One, 5 wide for a small account obviously would be cheaper margin in the SPX than 10 wide. Did you look at that at all?
Yes.
And the other thing is, does this get by the, I mean, obviously this still for a PDT, I keep thinking it's like a drug or something, PDT.
Yeah, PDT. Well, this one, you have no exit. So
no, you do have an exit, but it's only twice a week, right?
I'm looking at a different chest right now. That
this one's only
I'm running a test. Yeah, you're right.
So this one flag you though, right? So is the flagging 3 times a week or 2 times a week?
Third would, I believe, when it flags.
Okay, so this gets under the radar. I like that.
Yeah. So basically, we're running this one, and then the 2 other trades are just put on an expiry. So we're able to add.
Okay, I like
basically that. We're able to make let's call it 7 occurrences a week, or I guess 14 occurrences through the week between the 3 or 4 trades in the portfolio, and it still keeps us within PDT. And like the main goal is let's get out of PDT, and then we'll start getting into maybe a little bit of SPY stuff so we can size properly, and then, we can create a little more velocity for money.
That's great.
I was looking at another test that, Mark, I'll share here, the one you just sent me while we were talking. I was basing all my decisions off that one. So this is another one. Can you talk through that?
Yeah, so this is the classic, a lot of people call it all in at open. I think it's kind of fitting, but basically, and I'll link this article again, but they talk about it. So like on every test I use, especially when we're kind of cherry picking certain tests, I want to base some logic on it. So basically the risk premium overnight, which is, usually very high because we don't know what's going to happen overnight and the market's not necessarily liquid. So this is when the VIX opens up from the prior day's close at 415. So the kind of entire thesis behind this trade is if the volatility risk premium doesn't come out overnight, it's probably even more overstated basically during the day when it comes up. So what we're doing is we're saying, hey, we're going to take this trade right off the open. We're getting as wide as possible kind of on that open bid, and then we're just going to hold it. And again, I'll link the article, but in this article that talks about how basically dealers behave, generally throughout the course of the day, dealers will compensate, like they don't like warehousing a bunch of risk if it's really big trend. So, we may get some gamma spikes, or they'll increase the bid-ask spread if, they don't want to take as much put side exposure or vice versa. But generally in the first half hour of the day, they're just much more concerned with volatility instead of whatever risk they've warehoused, because they don't know what's happening over the course of the day and they don't know what occurs. So basically by doing this, we are taking a risk that is deemed unattractive by most market participants. And you can see that it's kind of backed here based on results. Granted, this year is dragged a little bit, but the degree to which we've had crazy moves for the first 4 months of the year has been, quite insane. So I do anticipate this kind of going on a heater in the future. And then also the benefit of this is it's easy to just wake up, put it on, you check it, and to kind of confirm what the VIX filter is. A lot of people screw it up. It's whatever the VIX closed at 415. And then whatever it opens at, the first candle is generally 931 or 932, because underlyings of SPX have to open, SPX has to open, and all the options in SPX have to have an accurate price, and the VIX is going to print.
Yep. No, that's exactly. Yeah, that's a great description of it. And one of the things when I look at something like this, I always think to myself, and this, I'm glad you didn't do this. One of the first things I always think to myself is, well, this could probably benefit from some sort of VIX min max situation.
Yeah.
But the reality is a little bit more complicated than that, right? Because some days when we're opening VIX up and VIX is 40, there's some benefits to doing this in that environment as well, I imagine.
Yeah. And like this skew will just get priced in. So I think maybe a better way to think about it is like volatility is always priced the same. However, we never truly know when that regime change is priced in. It does seem like the 0-day tenor gets priced in the quickest. And the other thing too that I want to bring up is like this ultimately does better because we're running everything in a portfolio. And if you look at the last trade we looked at, we're kind of benefiting from path dependence because we have that little 10. So if we fall within it, we'll take that 50% profit take. Whereas on this trade, there's no basically mechanics on it for that open trade. So we have no path dependence. We just care what happens before expiration. And then by combining both those trades, even though the setup looks very similar, 20 delta 15 wide, 40 delta 10 wide, there's actually quite a bit of difference between that. And, I'd run a correlation matrix on it or something if I showed more, but I'd be willing to say that these are extremely uncorrelated. And that's just showing how, cool the instrument is. And with backtesting, that these two trades are probably less correlated than like, the Japanese yen and the S&P, like very uncorrelated things. So by combining these together and knowing what those sizes are, it's pretty valuable. And something you could also do here, if you want to optimize the portfolio, you could see that we lose, roughly $800 on this trade when we lose. And then on that other trade, kind of the max we lose is, around 400. So maybe you do 2 lots for the afternoon trade and 1 lot here.
What you just said is really valuable, I think, to people. A lot of people, when they're getting into options trading, say, I could sell 0-day. I could be, that people see someone like you who's been successful selling 0-day premium and say, you just sell them all day. It's simple, right? And here's the back test. We go back and watch the video when it comes out, what he just said. Basically, there are different environments throughout the day that are taking place based on, I would argue, seasonality, vol regimes, all sorts of things are happening. And he's more or less advocating, his thesis is that he is running uncorrelated strategies, even though the strategy looks extremely similar. And that is really, really valuable information if you're getting into 0-day trading. It's not all the same. Just putting things throughout the day willy-nilly it's not the same thing at all. So, Mark, that's really valuable what you just said, I think. Yeah. Matt, Dan, anything before we move on to the other trade?
Yeah, I would just love for a second, not to get us out of the trades here, but Mark, if you could just spend a second talking about the role the backtesting plays in how you think about the markets and how you trade. We get a lot of new people, and there are a lot of folks who have either no experience with backtesting or maybe have done backtesting that's completely separate than the kind of high data resolution options backtesting that we've had for years, and they just have no exposure to it. So if you could just spend a minute talking about kind of the role it plays for you and how you look at it. I know that you could probably go a couple hours on that because I've seen you talk about that before, but I'd love it if you just gave us a quick thought on that.
Yeah. So the way I kind of view it is like humans have evolved to recognize patterns, and a lot of people like to recognize patterns just like candles or what they see on, the wall, and then trade it. And people can do well from that because options inherently have risk premium in them. So like it's a much better instrument to guess, gamble, take big risk on than like sports betting or than picking stocks potentially. But when we start to bring in back testing, we can now say, hey, this is the pattern I've identified. I would like to use some type of objective measure to see if I'm in or out of bounds with that. And then, we need to consider how robust and such that is. But almost the way I think of it is, it's like, there's people out there that make a bunch of money trading. There's a lot of bodies on there for people that use discretions. Like I used to proctor a Zoom group where we looked at charts and I said, hey, I'm going to sell puts in the last 2 hours of the day. Lo and behold, when I got into back testing, I realized that was the best time to aimlessly sell puts during the day. So like I recognized the pattern, but it was also based in back testing. And the biggest benefit from the back testing is that I could then automate stuff, which freed up hours and hours of mental bandwidth and willpower to eventually refine my craft. So like the way I describe it, which I actually just said stream of consciousness the other day, is like manually trading is like commuting. You have no value ROI. It's just your way you get to making money. Whereas if you're automated and from a back test, you all of a sudden are working from home, so you can be 10 times more productive and get paid for every input and time you have freed up to basically do what actually makes you money.
That's great.
Very well
Thank
said.
you.
See,
Yeah,
I'm
very-
65 years old, and I finally hear at 66 years old how to be efficient. It's too late. We needed this years ago when I was in the pit. You didn't really have you just learned by doing. And I feel like in the movie Moneyball, in that room, I'm one of those old guys on the other side of the table, and the young guy comes in and says, hey, the data shows this, and the old timers say, you're nuts. But it's like what I've learned, Mark, with the options Omega, because it's really haven't had this type of a tool for a long time. I didn't have a tool like this in the 80s when I was trading, that it can make things better. I mean, I might have said in the past, I'm going to take this thing off at 10% or 15. Now I'm learning from the data to really tweak things. I never even thought, Mark, of, when these guys would say, well, you don't trade Thursday or certain days to put it on. So strategies that I've been doing for years, like double calendars or something, I'm tweaking them based on models that, well, we found this. So it's just, I think what it is for people to be open to it. I've always been the the automated idea. I've always said for years, I said, most students, if they had fifth graders, that their fifth graders would do better than they would with following the guidelines and rules. And now that you have mechanical, you're really protecting consumers from their biggest enemy, and it's themselves. So I appreciate what you guys are all, the data is helping old timers. It just because they realize arbitrary, what do you call it? Arbitrary trading, or what's the
I'd call it discretionary. Or like,
that's
even the other flip end is like sometimes people will use back testing to confirm their discretion. And I was like, okay, well, we're one step further down the line, but if you want to use the back test to confirm it, I've been like, we'll work with that,
Yeah, that's right.
Yeah, it's a wonderful tool as long as you're not scared, and it's not like to be scared. It's going to make you better, right? So the discretionary traders, the old people that I know that are trading, they're looking forward to it because they're tired. Discretionary trading can tire you out and discourage you. So anyways.
Yeah. Well, listen, let's look at one more test, and then there's some questions in the chat from Mark, some of which are ridiculous and speak to the option Omega community in general, and some are good. So I will we'll go from there. But Mark, have we looked at this one already? Mark has been sending me tests like a madman. I was like, hey, just one test. He's like, bam, bam, bam.
So this one kind of same flavor, like not going to get us for pattern day trading. I wanted to not filter out any days of the week because this is good. I also wanted to add another entry time. So, if the market moves a lot at 145, we also have the 245 coming on. So it just gives us a probability to get the 10. So again, like further diversifying. Also with this one, we're taking more of a kind of, little bit of a skewed standpoint. So like you could even drop that first EMA trade on the put side, because this one is we're using our view that the market will go up, but we're doing that with kind of a delta neutral trade. So we have 40 delta on one side, 50 delta on the other. generally options decay and expiration. So it's a pretty good bet to be a little bullish at end of day. You could even see that this year, even with how terrible, the market's been, this has actually kind of worked pretty well. And then you kind of also eliminate all of those random tweets and gamma spikes that basically occur. And then kind of going back to, people love using SPX because it's a European option. So it's great to basically hedge. But with that comes a lot of up and down volatility and spikes in prices that can stop out some of your trades. So by using this, we can kind of just sit in there, we're going to expiration. That's how we can guarantee that we're going to realize whatever risk premium there may or may not be. And by doing this, it helps us out. Other thing with this is like a little more lower of a win rate trade and a little more boom or bust trade. So you can see that your max winners can be up to $1,200 in this, which is like really nice. And then your average winner is bigger than your average losers. So we're again kind of changing the probability curve within this small portfolio of like 4 or 5 actors. Look, we're throwing on a lot of really good diversity here. It's like, this is way better than most people's stock picking portfolios. And if a big move happens at 145 and spikes of volatility, we're basically reselling that volatility at 245 with that other delta neutral trade as well.
Yeah, super smart. To the question, Mark, are you okay if we share some of these tests in the Discord?
Yeah, I'll link them. They're all good.
Okay, cool. Appreciate you. And then,
as always, these tests, guys, these are a starting point. So these tests are shown. This is an idea generator. It's a sandbox. So take these and go crazy with them. They're a starting point. Some people look at these as the final boss. These still have a lot of customization. I mean, this backtester, you can make it do backflips. So play around with these tests and take them. And Mark, these are a fantastic conceptual. And I just really appreciate the thought that you've given behind the timing of them. And here on this show, a great explanation of kind of the why, because I think a lot of times people will look at a backtest and they'll spend way too few minutes and few brain cells thinking about the why that the backtest works or doesn't work. So I just really appreciate that.
Yeah. Another thing too, with people refining it, is like one thing to be aware of is generally like try to isolate one variable on one trade and improve it. So there's what's known as like the law of incremental degradation. Some people will call it, the girl in the red dress, whereas you add one component and it makes it better. And then once you make 4 or 5 iterations on 4 or 5 other trades, even though each iteration made each individual trade better, your portfolio is actually worse than where you started off of. So I think it's always good. Like, this would be great if you took this, saved it as a base, and then you refined it and made your own trades, but made one adjustment every 2 weeks that you thought you improved it, and then continue to compare it to that baseline over 3, 6, 9 months. Like, my biggest gripe about people I've met with backtesting is actually the short portion of making a backtested portfolio. The forward testing and tracking it to your results for 3, 6, 9 months and not moving it is actually the bulk of the work when it comes to backtesting. Obviously, you need to get at what you're trading, but like, we have forgotten about the forward test confirms the backtest, and tracking what those procedures are to make sure we have a good input is like actually paramount with doing this. And personally for me, it's like, I always knew how to backtest. It was good. I put a lot of work into it. And like, I didn't really get conviction in everything I was doing and have enough data for all the inputs till probably a year into trading the same thing for a long period of time. And then I really got into more of the optimization because I knew what I put in was going to come out crystal clear.
Yeah.
I think what you just said is brilliant. I think that's a reason, personally speaking, just looking at like things like RICs and double calendars and stuff like that, like people overfit to where what's working the 2 weeks, they improve upon it. But then in actuality, the 4-year test that was working great, that maybe had a drawdown, it's actually much better if you would just stuck it out. And so what he's speaking to is good for that. All right, let's take some questions real quick. Tom says, I'm totally not going to front run these back tests by 1 minute. I like that. That's not a question, but I thought that'd be funny to say everybody's front running each other. Did you see, Mark, the big hoopla a couple of weeks ago from OIC conference about the slide, the famous slide? Your thoughts on that?
I mean, I'm trading every couple minutes, so it doesn't really matter. It's like, it's not material. You know what I'm saying? If I ran some giant market making shop with an exchange license Do I think I could buy at the 15-minute intervals and then sell in between and like make a little money off the spread? Yeah, potentially. But it's like at its core, like we're taking risk. So we're going to be compensated for that. And do I think the degrading of, 1x stop MEIC is more lemmings pile into it will continue to come down? Yes. Just because there's that aggregate demand, but there's other ways to diversify across that. And every market and business environment changes and adapts over time. So I'm not necessarily worried about that. Interesting things I did see on that was like the first half an hour, dealers are concerned about volatility and not warehousing risk or whatever that is. And surprisingly, I don't really like to hold options that late in the day, but at the end of day, like dealers don't really care about warehousing risk. So they'll actually transact with you even if you're at a large size and somewhat close to the money. And it's not as worrisome as some people may make it out to be. Not saying that you should hold that, but if you do, that gamma exposure there on the spike, they're a lot more kind on transacting with you than they may be at, noon or something.
So interesting. Okay, so it'd be great. Kevin says it'd be great to have Mark on a future date to detail his hedging strategies for larger accounts. Agree, Mark. Would love to have you on to talk about hedging because you do some interesting things with hedging. Everyone wants to know how to hedge 0-day, and it's definitely possible, but it takes some thought, and I know you have thought about it.
Yeah, like I actually have recently kind of had a realization with this with like the last few months through testing a lot of trading on SPY, is it's like since SPX is, cash settled, it's really attractive for everyone to hedge with it. And especially on brokers like IB, they have the best portfolio margin. So that nature of like IB and SPX hedging, it's all about the long ball. And if you set that up, like it's such a good instrument to help you protect against your risk. And obviously you're still able to transact with the short side. So like I just keep on increasing my long volatility. It just further drives down my commission cost. It just further helps me out convexity wise. And it's like, that is really where the systematic portfolio is. And it's like, I'll even give the example. It's like, I've been profitable off long vol, and this was without filtering. I'm not just like trading RICs off the open of like systematically buying vol every single day. I've been profitable for like 5 months in a row on that.
Yeah.
The Trump market has helped it out, but
sure.
In general, I have the same exact premium capture on my long vol that I do with my short vol. The difference is credit trades are about a 45-degree line. Long vol basically oscillates across that. So it's all about understanding like, how am I giving up basically risk? And in return for that, how does that buffer the volatility or variance of my P&L? So it's all about having those balances between your credit trades, your stop losses, and whatever that is, and then getting enough occurrences so no matter when that spike happens throughout the course of the day, it can be profitable for you. And then also this drastically drives down, your wing cost and your commissions and fees, because what a lot of people don't understand, sell $2 option, pay 20 cents and crossing the bid-ask, commission, slippage, and fees in a wing, you just gave up 10% of your risk premium that you're supposed to be compensated for the broker. And like people will be criminal with this with selling 50 wide spreads. And then all of a sudden they're going up to 30% of their risk premium that they're sending to the broker. It's like, it's worse than taxes. Like, I don't think people really understand this. And in order to protect against that, it's like it's you ultimately understanding what that risk is and how to balance it over time.
We could do a whole episode just on what you just said. It's a interesting. Two more points. I'll save the best for last. Someone, speaking of RICs, has Mark Anderson ever traded a RIC in his life?
So it conflicts with my strikes. So like I run a really big account and I trade a lot during the day. So generally it's like I have to close that out to keep my credit trades going. So I'm predominantly focused on 1 day and further out for most of my hedging. And also anyone who's traded 112s or most trades, it's like, what's the problem? You sell vol at 15 and then you own it at 40. I'm basically doing the opposite. I'm buying vol at 15 and then I open it at 40. So it's like I'm selling a condor that's, $100 out of the money, and I'm rooting for that thing to get stopped out because I'm just so deep in the money on all of my hedges and other trades. And then the decay goes faster. So personally, I do not do any type of RIC, mainly just because it goes with my strikes. I also prefer convexity. So like I'm just dropping basically all the wings on my long ball. And if you look at it, like the path just gets rockier when you drop the wings. However, it basically ends up making the same P&L over time.
Yeah, makes total sense. Last really statement, not a question. Mr. Flawless says, I cried when I saw that Mark shaved his mustache.
Yeah, my girlfriend did not. You want to come on? Yeah, my girlfriend.
We shout out to the girlfriend. I love it.
Yeah.
Shout out to the girlfriend.
Yeah. She did not like my mustache. So, we had like my joke is like I was getting lobbied and, I was just getting indoctrinated by it that I had to lose the mustache. So,
yeah.
I hope it comes back, but we'll see.
I had a post Easter mustache for a week. And I mean, the ridicule and the hate, it's painful and it hurts. So I'm going to leave it there. But anyway.
I just kind of felt like a piece of meat. I'd be like, come on,
dude,
eyes up here. I am a person too,
Dude, I'll see you at the support group. I'll see you at the support group. The final thing, it looks like you have a helicopter on top of your hat. Your hat is a helicopter head because of the fan. So shout out to that. I love that. All right, guys. So listen.
Thank you, Mark.
Thanks.
It's been incredible. Mark, thanks so much for taking the time. We would love to have you on more. I mean, the way you think about selling is in my mind, the right way. I mean, we have different opinions on things, but I think you do it the right way, and you've definitely put the time in. So congratulations to everything you've accomplished in the last year, and no doubt will continue to accomplish. So we'll definitely have you on again.
Of course. Thank you, guys.
All right, guys. Have a great day. Hey, and before I forget, we have a very special OO show tomorrow. Speaking of automating strategies and things like that, you might want to be on for that one. So we will talk to you tomorrow. Have a good day.